Hello, welcome to another episode of Your Money Matters. You know, I love these episodes and being able to share information on finances and how to improve your financial literacy. We really want our church family and all of our visitors to truly understand how to make money work and to be intentional when you want to be more financially independent. And it can be yours if you do some of the things or some of the principles that we have suggested over the last number of months. Again, it's about changing your mindset and being intentional on what you do. I was just listening to a program on the radio on the way in, and it said, in a commercial talked about save money today to have money tomorrow. I think that as simple as that is, what a marvelous principle. So today, remember what we do with Money Matters. We help you with financial literacy. Again, we look for business opportunities, ways to make money, where it be education or just making yourself better. We help you to think creatively and also to think critically when it comes to making purchasing decisions. We want you to get your credit rating up to a minimum of 700. Remember, when you have a credit rating of 700, it allows you the flexibility to buy money at a much lower rate than if your credit rating was at 650. So let 700 be your goal, and you can get there, and I have techniques to help you to get there if you'd like to know. And finally, getting out of debt and ways of not getting into debt. And once you get out of debt, not making the same mistakes you made prior to getting into debt. But today I'm going to give you some financial rules of thumb. Now, I get this information from a variety of sources. You know, whether it be Dave Ramsey or anybody similar to him, but almost everybody says the same things. The principles related, whether it's Dave Ramsey or Warren Buffett, the principles are about the same. So let's visit some of those today. First, save a minimum of 10% of your gross income. A minimum of 10% of your gross income. If you make, to simplify the math, if you make $100 and the federal government takes anywhere between 10 and 15 of those bucks, then you take $10 of that and you save it. Some going into an investment, some going into a savings fund, just in case of emergencies. 2, plan on needing 80% of your pre-retirement income to live off of in post-retirement. We spent a little time last couple of weeks actually, on retirement. And remember, Social Security was never designed to take care of you completely during retirement. As a matter of fact, when Social Security was created, it was designed to give you 40% of the income that you needed. It was designed to support what you needed, but not completely support you. So look for ways other than the Social Security to get there. And realize that for the most part, you're going to need about 80% of your pre-retirement income to maintain your lifestyle. Secondly, set a percentage in buying stocks. I was talking to a guy, an ex-principal as a matter of fact, smart guy, you know, and we were talking about stocks, and he said, well, you know, he never felt comfortable investing in stock. Well, in investing in stock, it's like anything else, it's risk tolerance. can you stand the risk or not? Now, there are some ways that you can invest money that have little or no risk. Usually, you make anywhere between 1, 2, 3% on your return. But if you're willing to risk a lot, let me tell you a rule of thumb by age on how much of your retirement income should go into stocks and bonds. You should use 100% against your age. For an example, if you're 50, then only 50% of your money should be in the stock portfolio. If you're 30, you should have as much as 70% in the stock portfolio. Remember how stock works and how the stock market works. Yes, there are ebbs and flows and pros and cons, and it goes up and down, but over time, on an average, the stock market has always gone up. The stock market has always gone up. In 2008-ish, when we had the big housing crisis and we were in the heart of a recession, the stock market had went down to around 8,000. Well, right now, today, the stock market is over 32,000. About, I don't know, a couple of years ago, I'm actually on the way to church, on the way to St. Stephen Baptist Church. And I happened to have, I can't remember the program that was on. And this guy who was an investment person says he predicted that the stock market would get up to 32,000. I think at that time it was around 22,000. I'm thinking, I don't know if that's possible. But again, as a matter of fact, today is almost 33,000. So the stock market always goes up. If you are under 70, if you're under 65, 70, and there's a dip in the stock market, do not panic and take your money out of there. That dip will not last over a year or two at the most. So, an example, in 2008, when the stock market went down to 8,000, if you had some good solid stocks, some blue chip stocks that made sense, if you took your money out of there panicking, look at all the money you lost. If you hung in there long term, if you were 30 years old, 40 years old, and you hung in there, now 12, 13 years later, that same stock is up to almost 33,000. And if it was a good stock, you made money on it. Number 4, you need to have an emergency fund that's you need to have either 3 to 6 months of emergency fund. Always. Well, how do you get emergency fund? Well, remember, number 1, save 10% of your gross income. Either have a portion of that money that goes into a fund that funds an emergency fund, as well as a fund that goes into an investment fund. You need them both. There will be a rainy day where you will need to put your hands on $1,000. Please, family, please do not be one of those people, one of those 45% of all Americans who did not have $1,000 saved in December 2019. That's one of the many reasons the pandemic was so devastating, because people were not prepared. Almost 80% of all Americans, whether they make $20,000 a year or $200,000 a year, live paycheck to paycheck. Don't do that. Save a minimum of 3 months, whatever you need, 3 months in an emergency fund, and try your best to get it up to 6 months. It's another way of staying out of debt. If you have an emergency fund, then you need not put emergencies on a credit card when they're unexpected. Number 5, pay no more than 20% of your take-home pay on short-term debt. And 20% is pretty high, to be honest, on short-term debt. if you bring home $800 a week, or let's say $500 a week, then you only want no more than $100 of that going toward short-term debt. Remember, usually, as a rule, short-term debt has a higher interest rate than long-term debt. So make sure that when you use credit in the most cost-effective, long-term way that you can handle debt. Number 6, keep your rent or mortgage no more than 30% of your gross income. Now, what's that look like? The average household income for African Americans in this country is around $45,000 a year. That's approximately right at $3,750 a month. Now, what's that look like? That's about almost $22 an hour. Well, remember, that's household income. So if you have one person in the household making $11 an hour, and another person in the household making $11 an hour, and they both work 8 hours a day, that equates to right around about $45,000 a year. So let me give you some principles. Let me share with you how you get that household income up in the value of working as a team. One thing Warren Buffett said, he said one of the ways to be successful is making sure you choose a right mate. So have a person that you're really working together with. Now let me tell you what happens if you and your partner are working side by side with common goals, and now you're making $16 a month, and she's making $16,000 a month, or she's making $16,000 a month, and he's making $16,000 a month. Let me tell you what that looks like. Now, that's $16 an hour. I'm sorry, not a month, $16 an hour. Now that's $32 an hour. If you take $32 an hour and both people are working 8 hours a day over 52 weeks, that takes your household income from $45,000 a year to over $66,000 a year. Now think of all the extra things that you can do by making literally another $20,000 a year. How that puts you in a better position to buy a home, to start saving money, because you and your partner are working together. But let me give you another piece of information. I'm giving you techniques, I'm giving you goals that you can set up with you and your partner in order to live a life better than you're living now and putting yourself in a position to save money so you can retire. Let's suppose both you guys are making $20 an hour. Those kind of jobs are out there. If you're making $20 an hour, collectively you're making $40 an hour, then that's collectively you both. That's $1,600 a week. That's $800 each. That's not counting any overtime. That takes that $45,000 that the average black household makes to $83,000. You can see, if you take baby steps and you have goals and you are intentional on how to deal with your money, and remember this, when you're making, if you can take $45,000 and get it to 66, don't spend like you're making 66. Spend like you're making 50. Never spend more, always live under your means. And if you can get your total household income up to 83, almost 85, then you spend like you're making 66 or 70. That way you're always saving money. That way you're not one of those 80% of Americans who live paycheck to paycheck. Number 7, if you have a mortgage and you're a property owner, refinance when you can. Interest rates right now are lower than they've been probably ever. I mean, you can get, if you have a good credit rating, and that credit, I mean, and a lot of times even if it's in the mid 600s, but if you have a 700 credit rating, you can get a mortgage today at 2.5% on a 30-year note. That is incredible. But if you can save it a minimum of 2%, maybe a 1.5%, you always need to consider refinancing. Let me tell you what that looks like. If you owe $175,000, that's what you have left on your mortgage payment, and your interest rate is at 4%, that payment is almost $1,100 a month. It's about $1,060 a month, depending on what your taxes are, based on where you live, and what your insurance rates are, because that affects what they call your escrow. But as a rule, that payment would be about $1,060. That same $175,000 at 2.75%, that's less than 2%, that payment goes to $833 a month. So you save about $172 a month. Over the course of a year, you literally save $2,000. So now you could take that extra $2,000 just because you decided that you're going to get your home refinanced, and you can take that money and maybe add it to your emergency fund, maybe add it to your stock portfolio. Don't take that money and create more debt. Use it to pay off your short-term loans. This is how you work your money. Give you techniques on how to really work your money, not let your money work you. Look for good partners. Look for ways to work together. Be intentional in what you do. Number 8, purchase life insurance. Now, there's a lot of different theories on purchasing life insurance. Some people will say, only buy term, because term is a ton cheaper than whole life policies. Some people will say buy whole life policies because there usually are components in a whole life policy where you can also save money. So I believe a lot like those who buy stock and those who don't buy stock, it's a personal preference when buying life insurance. You can buy a lot more life insurance if you buy term at a cheaper rate than you can buy a whole life policy. But let me share with you a story, a real life story, my story. I had a guy, Ed Barnes, good brother. In 1992, came to me and convinced me to buy a whole life insurance policy from Northwest. I did it, a couple $100,000. At that time, I was in my late 30s. But let me tell you what I did. It's a lot of what you need to do. We're going to talk about this later today when it comes to saving money. Rather than me writing a check every month, it just automatically went out of my checking account. So it just became part of an expense every month. Now, okay, that was 1992. So now, 30 years later, actually this happened 5 years ago. Now that policy is paid up. I'm growing cash value in that policy every week. So the money that's paid up in it is also growing cash value, and I never have to make another payment. Now, the thing about term is the word term. It does have a term. It's 20 years. If I decided that I wanted to do a 30-year term, then my life insurance would have been expired by now. But because I did buy a whole life policy, now I still have my insurance, and as of today, I never ever have to write a check. So when God calls me home, that my wife and my adult children will always have something that they can use in my absence. Number 9, always review all your insurance policies. Speaking of insurance, always review your car insurance, your homeowner's insurance, any kind of insurance like that, please review. Many times, and I get it, trust me, many times we buy insurance from people that we like, people who are friends of ours, people who have good intent. They do. I had a co-host that worked for a fine insurance company that I used to do business with years ago. Can do everything you need them to do. But I'm telling you, we're talking about you saving money. And these insurance companies have got tons of it. They have billions. So every year, review your car insurance and your homeowners. I'm not going to name the name of the company, but I changed both of those insurance. I did 3 weeks ago. Because the company that I've been using for 5 years, a great company, decided to go way up on our auto insurance. Well, I got good credit. I haven't had any accidents. They just raised it. So I started looking. Now I save about, if you do it monthly, about between both cars, about $50 a month. Same coverage. And then I decided, well, let me look at the homeowners. Well, tell you what happened. We had some hail damage about a couple of years ago. So we had the insurance company put in a roof on the house. Well, our insurance rates went up 30%. So, well, I need to shop this. Family, let me tell you, it took $1,300, I want to get the number right, off of my yearly premium on my homeowners. Great company, saved us tons of money. And then guess what happens? Because we're making a house payment, it will eventually lower the escrow. That's the money that your mortgage company puts in somewhat of a savings account to pay your taxes and your insurances at the end of the year. It's basically there to protect them, not just to protect you. So, review your insurance policies. So let's spend a little time on, we talked about savings, how you save. How do you save money, all right? Always have an emergency fund. You save emergency fund, you save for retirement, you save to buy a car, you save to buy a house. You always have goals. When you save, you have goals. And if you have a goal, have that goal written down. We said many times, if a goal that's not written down, it's just a dream. Have it where you can see it. Put it on the mirror in your bathroom. Make sure that you look at it every day. Have a goal. Let that be embedded in your brain on what you're trying to do. So when you're thinking about buying something on an impulse, you won't, because you have a goal. Number two, determine how much you want to save. We talked about 10%. But save as much as you can. If you can save 15%, when you save today, you have money tomorrow. What you save today, you have money tomorrow. There's many things that I've done over my lifetime that if I could change them, I would. Trust me. But if there's one thing I did do, and I did it consistently, is I always save money. Always had the life insurance policy that was always paid on, and I always save money every month. That put me my wife and I in a position to be able to live a relatively comfortable life with not a lot of drama. All right. Number three, consider the timeline. A goal without a timeline is also a dream. I want to get this done by the end of the year. By May 31st, I'm going to lose 10 pounds, or whatever that goal is. By the end of the summer, I'm going to have 2 of my credit cards paid off, and this is how I'm going to do it. By the end of the summer, I'm going to have $750 in my emergency fund, because you never know when that car is going to need something that you didn't expect, or who knows what may happen at your home. Number 5, automate your savings. That's what we talked about earlier. On that insurance policy, the reason it was easy for me to maintain that over all those years, and remember, the younger you get it, the cheaper it is. The less expensive it is. So, I got into my 30s. If I had got that same policy at age 50, that would have been at least another $100 a month. But it went out of my checking account every month. I paid Uncle Sam first. We paid the federal government first. Paid myself next. Always choose to save in the right way. 401ks, IRAs, stock portfolios. There's a ton of different ways of saving money depending on your risk tolerance. And number 7, and just as important, watch your money. Check your credit rating regularly. Watch your money. I watch what's going on in the stock market every day. I know when I made money. I know when I lost money. I don't panic when it goes down. I don't have a lot of joy when it goes up, because I know the next day it could go down. So those today are just a few financial rules of thumb. Hope it helped. If you need me to help you in any way, or is there any other subject matter that you want me to help you with, go to g.demaree at ssclive.org. g.demaree at ssclive.org. Tell me what you want me to talk about. Tell me about what you need. If you need help in improving your credit number, I have a technique to do it. So, again, thank you. And as always, at St. Stephen Baptist Church, God loves you, and so do we.